Let's look at some Dow Dangers. Now, a lot of investors are far more exposed to the Dow stocks than they realize. Common mistake investors make is comparing their returns to the Dow. Why? Because the media does. Market up, market down. Well, they're typically just talking about the Dow Jones stocks. But if we look at long periods of time, we see that many areas of the market have far outperformed the Dow. But sometimes the Dow does outperform a diversified portfolio, and we see the years right here that it had. If we look at longer periods of time, now here's what we want to focus on, is a well-diversified portfolio typically outperforms the Dow over time. Dow is really only 30 stocks. A lot of people don't realize that, but it makes up a big proportion of many index funds, like the S&P 500. If you look at that, 39% of the value of the S&P 500 is those 30 Dow companies. Now, if we look at a total stock market fund, which holds over 3,000 stocks, the Dow still makes up 32% of like a Vanguard total stock market fund. So a lot of the return of that total stock market fund is just because of those 30 holdings. 83% of the total stock market fund is those 500 companies in the S&P 500. So we see that many of our portfolios are driven by just a small number of stocks. How about a properly diversified portfolio globally invested in 14,000 companies? Those Dow companies only make up 2% of a portfolio that well diversified. So what are some of the takeaways? Well, number one, a well-diversified portfolio shouldn't move with the Dow all the time. Sometimes it does. But here's the deal. Sometimes the Dow is going to outperform a diversified portfolio, but often it will not. And the other takeaway is many investors are far too exposed to this small group of stocks. So one of the first things that we look at when we work with people, making sure you're not overly exposed to a small number of companies that can hurt you in the long run.